Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with your regular host with a special Market Signals. I am probably going to talk as little as I have in any of these episodes because we have four speakers today. We have Lawrence Gillum, our chief fixed income strategist. We have Christian Kerr, our head of macro strategy, and we have Adam Turnquist, our chief technical strategist, along with myself to try to put this sell-off in context, give you the latest news on tariffs, and talk a little bit about where we might go from here. It is April 7th, 2025 as we're recording this. And here is our agenda. Of course, we actually entered bear market territory intraday today. So we define bear markets based on close. So if we don't close down 20% on the S&P 500, we will not call it a bear market, but we did enter bear market territory. So we'll talk about the sell-off next. So just updating you on the latest news on tariffs and prospects for potential negotiation. Then we'll talk to Adam about technicals, what signals he is watching to tell us a turnaround might be coming. Then Lawrence will talk bonds, and certainly the bond market is getting even more interesting because yields are rising pretty sharply today, which I think probably a little bit surprising for folks as recession risks rise. So look forward to hearing from Lawrence on that. And then we also have Christian to talk about sentiment. I guess I got my agenda was a little full, so I didn't put a sentiment bullet here, but positioning and sentiment, we'll hear from Christian on that again for guidance on where this market might settle down. And then the week ahead, of course, is more tariff headlines. Nothing else really matters. So we'll do the recap quickly here because, we all know stocks have gotten hammered and we really want to try to look forward rather than looking backward. But 9% down for the 5 days. Most of that, of course, coming at the end of the week. Adam, I'll turn to you on this. I mean, it was clearly ugly. Did anything in the sector leadership or asset class dynamics stand out to you last week as what looked like indiscriminate selling unfolded?
Yeah, I think indiscriminate selling is probably the best description. I don't think risk off really even encapsulates what we witnessed last week. We had record type volumes across the S&P 500. At 97% of stocks actually closed lower on Friday. So that is signaling a flush. People selling what they can, not necessarily what they want. And I thought it was interesting going into Liberation Day, of course, a big event that we've all been waiting for, just the lack of implied volatility going into the event. The VIX was in what we call backwardation, but that had started to back off a little bit. So the market wasn't really bracing for impact. So definitely caught off guard to say the least last week, and pretty broad-based selling. Utilities holding up a little bit better, staples holding up a little bit better last week, but still getting sold and very oversold, really, when you look at some of the momentum across all the S&P 500 sectors. A lot of technical damage as well, not only in big tech, but also in even some of the more defensive areas of the market. So definitely a tough week for equities.
Yeah, that's kind of the last phase of one of these big drawdowns is even the defensive stuff sells off. And so we saw some of that, seeing a little bit of that today too. But I unfortunately have to admit there's a little bit more downside here if we don't get any good news on tariffs this week. We'll have to wait and see. Turning to you, Lawrence, on the bond market. We had a good week last week. I mean, we're not having a good day today, but anything in terms of high level, how the bond market performed late last week that you would like to highlight?
Yeah, and I will keep this higher level, but it really was a good week, relatively speaking, for higher quality fixed income markets. So treasuries, agency mortgage-backed securities, investment grade corporates, all up on the week. But the plus sectors, the riskier sectors within the fixed income markets, traded in concert with what we saw out of the equity market. So high yield bonds lower, preferreds lower, emerging market debt lower. So we really did see kind of how we would expect the bond market to play out during any sort of economic slowdown, recession conversations picking up with the high quality fixed income sectors outperform the plus sectors. As you mentioned, the price action today is a little bit different. We'll get to that when we get to the fixed income section. But last week traded relatively in line with what you'd expect the bond market to do in these types of economic and equity market volatility episodes.
Very good. So let's move on. So where do we go from here? This is the weekly market commentary for this week, which is posted on LPL.com. I'll be quick with this because you all know high level what's going on here. Trump imposed these really adverse tariffs, right? The market was really not prepared for anything more than 10%, possibly a little more. And if you do the math and put in all the tariffs that have been announced and what potentially is yet to come, here one research shop, Evercore ISI, predicted that you'd be at 27%. That was not on anybody's bingo card. Strategists, and I guess most of the strategists that are doing the math on this are looking at maybe more of a 20% tariff rate. That is still higher than what the market was prepared for. We thought we'd come in maybe in the low to mid-teens, but then quickly negotiate those down. Now we're coming in at 20, and it looks like we're not quickly negotiating those down. So the potential for tariffs in the mid-teens to stick is certainly higher than we thought, higher than the market thought, and that's why you're seeing the market sell off so violently here since the April 2nd announcement. The Asian countries, particularly China, were hit the hardest. Vietnam, another one, hit the hardest, although they've already offered to go to zero tariffs. They've already started negotiations, at least in the headlines. And so, the Trump administration said they'd fielded something like 50 countries' calls already. So the negotiations will happen and probably bring these rates down. But with China, that's going to be a real tall order. Clearly these trade tensions and the objectives of the Trump administration are really inconsistent with a quick compromise on China. But hopefully we'll see these rates on other countries come down pretty quickly. Here are the countries you really need to focus on as we walk through in the weekly commentary. It's Mexico, China, Canada, and the European Union, led by, of course, Germany. I mean, Japan matters, Vietnam matters, especially for countries that are manufacturing a lot in Vietnam. Many moved from China to Vietnam during Trump 1.0. So, but really, it's maybe those, we'll call it 5 countries / regions that you need to focus on. I guess before we go into the charts, I'll just open it up to anybody who wants to weigh in. Anything on the negotiations that you've seen in the headlines that give you confidence that any of these countries could actually see lower rates right away?
Well, I think more importantly, the markets are sitting here thinking, they want to be somewhat comfortable that we've gotten to that point of peak pessimism, and we just haven't seen it yet. Now that could easily change. We come in tomorrow and we start seeing deals getting done. I think that would go a long way. But clearly, kind of with what's going on with China, where that just seems to be ratcheting up a little bit with what happened Friday, and then this morning with some of the tweets from our president. It's the markets are just wanting something to show that we're kind of, this is going to keep escalating, getting worse, and until we see that, it's just difficult to be able to put a stake in the ground and say we've reached that peak pessimism point. But it's probably closer than we think, or hopefully it is. It's kind of just my high level take here.
Yeah. So on that headline, which the White House subsequently refuted, that they were looking at a 90-day pause in tariffs for everyone except China anyway. I think the S&P intraday jumped 7%. So clearly we are in a coiled spring. And so if the news starts to get better, this market could move. I'll ask Adam here in a minute, maybe where we could go if we do bounce. But Adam, let's get into the charts here and talk about this. So next level of support, I think, is probably the number one question that you get. I don't get too many questions on technicals because people know I'm a fundamental guy. But so what is the next level of support, and what could happen if we break that?
Well, we took out the August lows last week. That was a big one. So now that leaves us kind of near the April 2024 low, right around 49.50. Interestingly enough, too, that's the qualifier for bear market territory. If you take a 20% drawdown from the February high to right around 49.50, that gets you to that April 2024 low. If we break that level as we did intraday, there's a 48.20 level on the S&P 500. That's a 50% retracement of the bull market run from October 2022 to those February highs. The rule of thumb among a lot of technicians is that the most common retracement is right around that 50% mark. So that would be right in line with price action intraday. We got very close to retesting that. And it also lines up with the 2022 highs right around 4,800. So that's going to be a big level if we get some additional selling pressure today. We have a very big range on the index as well. A lot of times you'll see these big ranges on the index near market lows. So something we're watching, of course, volume as well. And then how oversold we are. When we look at the middle panel, that's the percentage of stocks with a relative strength index or RSI reading of less than 30. That's the technical threshold for oversold levels. You can see there 46%. That's the highest it's been since the correction lows of 2022 or the 2023. And then just the relative strength index, that momentum oscillator at 23. That's the lowest level, meaning the most oversold the index has been based on that indicator since March of 2020. So a lot of technical damage. We're starting to see maybe some support around those retracement levels and the 2022 highs. Very widespread oversold conditions. So if we're playing horseshoes, we'll call it close enough for the long-term investor when you start thinking about the risk versus reward here. If we're playing darts, I don't think you can call the bullseye here yet, but I think we're getting pretty close. If we're just looking at pure technicals, we're ignoring the headlines and the why, and we're just looking at the what. And when we look through our checklist of trying to identify a market bottom, I think we can make the case here. We're getting close.
Yeah, there I go back to the news flow. Once the news flow gets better, a lot of these ingredients for a market bottom are in place. And that doesn't mean that we're going to necessarily go off to the races when the headlines do get better. So let me ask you that question again, Adam. So where could we rally to? It looks like the way you've drawn this chart that there's a little bit of runway above 51.32. Where do you think we could go?
Yep. So 51.32, that's another retracement level. You have the September lows, 5,400. You have the summer highs of last year, right around 56.67. So there's some decent upside. I'm not sure if it's going to be that V-shaped recovery I think investors might be hoping for, given the headlines that we have to navigate around. But I think establishing a floor here and some more offensive leadership will be a good sign. So some potential upside there. And I think when you zoom way out and you look at the overall trend for the market, going back to the pandemic lows of March of 2020, you tie that to the bear market lows of 2022, and you're still in this, we'll call it bull market uptrend, even though we're flirting with breaking those levels in this latest pullback. But more to come this week in terms of if we get that capitulation point.
Yeah, and you can also haircut the PE, right? We were at 23 times not long ago, now we're at 18. Use a PE like that and haircut earnings from tariffs, and you can still get to 4,800 pretty easily. So I think even some of the bears are starting to get interested in stocks down here. But let's keep it on technicals. This washout, I mean, you can define washout selling a number of different ways, but based on what you're seeing in Brett, that seems to be a washout here as well, Adam, right?
Pretty much, especially when we look at the top panel there, that's the percentage of stocks above their 20-day moving average. Historically, anything below 10% in that indicator has overlapped with a correction low or bear market low. Of course, it doesn't mark the day it occurs, but that's one of the metrics that we look at. And then when we zoom out a little bit longer term in terms of breadth, percentage of stocks above their 200-day moving average, that's the bottom panel at 23%. I checked that intraday, we got down to 18%. Now, when you have a bear market without a recession, that averages right around 10 to 12%. When you have a recession, as we did in March of 2020 or the global financial crisis, you're talking low single digits, just to give you some context there, but getting very close to getting a washed out signal on that longer term breadth measure as well.
Yeah, and we priced in a pretty high likelihood of recession if you assume recessionary declines are around 25% by some you depends on which ones you include and exclude. But if you've gotten like 19 out of 25, that tells you the market's maybe pricing in a 70% chance of recession. So a lot of damage certainly is done here. Let's turn to the VIX, Adam. I guess this didn't quite get as high as the last summer highs in August, but it came pretty close. Does this check the box as a panic, fear-driven sell-off that might be a contrarian buy signal?
Yeah, here's another one that's probably close enough in terms of hitting that high of last year. That one comes with an asterisk as well. There's some debate back and forth on that VIX intraday high, but we had a 60 handle at about 3 a.m. on the VIX Sunday night or Monday morning. That definitely qualifies as panic coming into the VIX. And you can see we backed off that level a little bit. Now, when you look historically and you backtest the VIX, what level really matters for a capitulation in terms of seeing above average returns? And we found that an intraday high on the VIX above 30.1, that's the qualifier where it becomes significant. And that's a top decile reading. We're obviously well above that with a 60 handle. That's probably in the top 99th percentile of VIX prints intraday high. So good sign of panic here on top of oversold conditions and those washed out conditions that we talked about. You can see it as well, that panic going into the market in the shape of the VIX curve. Now, normally the front month or spot VIX trades at a discount to the longer dated contracts, which require a time premium. When there's panic and investors rushing to hedge positions, you'll see that invert, and it's called backwardation. And we had a surge in the spot VIX trading above, in this example, the 6-month VIX futures at 20, almost 24. That's historically high and also overlaps with usually near or at capitulation points in the market. Put call ratio is another metric that we look at that nearly got to a 2 standard deviation move on that bottom panel. I think I didn't get the update today, but we're on Friday at 1.22. That means there's a lot of put buying in the market versus call buying as investors are panicking here. And that is, again, nearly at a statistically high level. And those are, you often get a big spike in that put call ratio at or near market bottom. So some good signs in some of these other metrics that we look at outside of just price action on the index.
Yeah, certainly all points to staying the course here. We certainly would not panic sell at the lows. Even if there is a little bit more downside, it's pretty easy to see the upside as certainly outweighing the downside now that you're already down pretty much at bear market levels. So thanks for that, Adam. Anybody want to add anything to the technicals before we go to sentiment and positioning? All right, we'll go to sentiment and positioning. So Christian, you're up. I've been hearing a lot about how retail hadn't capitulated. So I certainly want to hear from you on that. But what are you seeing in terms of sentiment surveys, and has there been enough? It's one thing to say that you're bearish, but it's another thing to actually move money to reflect that bearishness. I think that distinction is important.
100%. That's why I think a lot of surveys kind of are lacking in terms of their usefulness, because it's a very different thing to put money on the line versus saying I'm bullish or bearish. But this is an index or a sentiment survey that I have followed going back to before the financial crisis, and it's interesting because the way it's constructed, it's essentially short-term retail self-directed futures traders that are trading these positions. So when we call it DSI, when the DSI gets to sub 10, I've seen it my whole career. So basically, out of every 10 traders surveyed, 9 of them are bearish. you start getting those levels and below, you tend to get really meaningful lows somewhere soon, right? Not necessarily right away. And it gets really interesting when you get sub 5%, which we didn't get. We're at 10% right now, but just something to keep an eye on, as we've gotten to what I would call just bombed out levels of sentiment. And you can see on the chart, you go back to, basically COVID, March of 2020, didn't, when we got sub 10, didn't bottom right away, but those are basically levels where we started to feel out, started to base in the index. Then, go back to the 2022 bear market, same type of thing, started to get to kind of these levels of sentiment. And we started to kind of find that footing before we turned higher. So I think it's just an important kind of indicator that I like, that I've been watching for a long time, that suggests we're getting close to an important level from a sentiment extreme standpoint.
Very good. Certainly seems like sentiment is about as bearish as it can get. So here's my question on retail, Christian. They have not really panic sold. At least they didn't on Friday so much, based on what I can see. How are retail investors acting now, as far as you can tell?
Yeah, it's been, and again, we talk about retail. We're talking about kind of your self-directed Wall Street bets type of investor, not necessarily someone that's with an advisor. So, very kind of your gung-ho type of individual trader, very aggressive speculation, using a lot of leverage, using options, things like that. But yeah, according to some of the data that we look at, they were at, it was one of the highest net buy days of them on Thursday during the collapse.
That's
And
crazy.
then, yeah, and then the next day they did it again in less amounts, but they are still very aggressively buying the dip. And that is the contrarian signal to where, historically, when you had these self-directed traders buying so aggressively into these types of declines, it usually doesn't end, or you get the all clear signal when they finally capitulate. There were some signs of capitulation, I think, this morning. I think it also explains why, something like Bitcoin has done well, because that's heavily influenced by retail traders. They were obviously putting money into the market in the things they like. So I think Thursday, Friday with crypto kind of holding up probably came from that as well. Again, you don't need to see this. It's not a must. It's just another thing on that checklist that we're looking for. That if you were to see kind of this cohort of investors capitulate, it'd be a very strong sign that we've got a more meaningful low in place that we can kind of hang our hat on a little better.
Yeah, I like hearing that capitulation word, because that I was in this business during the financial crisis, certainly during the pandemic, yeah, even the dot-com burst in 2000, right? And these types of environments where you see that capitulation, again, that indiscriminate selling, the high VIX, the put calls, like Adam said, these, again, you don't know if it's that weak, but the bottom is very close as you price in max pessimism. So certainly that the high volume on Friday, Christian, was more evidence that it was, potentially a capitulation low, or at least very close to one. Because even though, retail was aggressively buying the dip by that measure you just showed, this is maybe evidence that people were just either buying the dip or selling aggressively, because the volume was massive.
Well, I think it goes to Adam's numbers, right? If it was 97% to sell the volume, the 3% was probably that cohort. But no, I mean, I think when you stop and think about kind of where we are, the decline. I mean, we basically started selling off in February, so we've had weeks of going down, but it's been very, very orderly. I've even mentioned a few times that from a global investor perspective, it hasn't really felt like risk off, because money was being taken out of the U.S. markets and going to international, and those markets were doing well, and it didn't feel like a risk off, and all of a sudden that became very risk off very, very quick over the last few days, where it did become a global phenomenon. We saw the Euro Stocks 50, which has been doing very well for 6 months, gave back all those gains in the span of a few days, right? So and I think going back to that, when we've had this orderly decline, it's been very difficult to say, well, where are we going to find a base? Where are we going to find a footing? And it's almost perversely, you want to see this exhaustive move. You want to see this capitulation. And I think these large volume numbers suggest that. And historically, that's been the case. Now, there is a little bit of potential issue that when you're in kind of this waterfall pattern and you get a record volume day that you're not going to see it right away, but you're getting very, very close. And I think that's what this highlights, right? Is that we basically started to get that exhaustive phase, that indiscriminate selling phase, and at least some sort of tradable low is probably going to be in place here shortly. Now, whether we get a major V bottom and we're back off to the races from a more cyclical standpoint, you can't say that just given the volatility of the moves. Impossible to know, but at least some sort of footing for the market is probably closer than you might think, given what we're seeing in the headlines, just because of things like this and the sentiment picture as well.
Sure. Yeah, I remember trying to trade the low in 2020 and expecting a retest that really didn't come. I mean, it was the same thing coming out of the financial crisis at times. You can't count on that retest happening, but it does happen more often than not. And so we may see that. We may see a bounce, a double-digit bounce, and then we could roll right back over and come back to the lows. That's something to watch out for. So let's now turn to the bond market here. Unless anybody wants to add anything to any of those comments from Christian, feel free to jump in and interrupt. But Lawrence, I think maybe your title here, still relatively calm, makes sense for credit markets, but does it still make sense for treasuries after what you just went through here earlier in the call? That's been a pretty big sell-off here today. So help us make sense of that. And where do you think the 10-year might go?
Yeah, so that is a dated title for sure. We submitted that to compliance earlier today. But you mentioned the equity market sell-off that was about a 7% difference. Just looking at the 10-year Treasury yield, in a matter of minutes, it was higher by about 34 basis points from the low. So we saw a big whipsaw today on some fake news, apparently, about a moratorium of a 90-day suspension or pause on tariffs. Turned out to be not true, but it certainly disrupted the fixed income markets, at least the rates market. But even before the volatility in today's market, one of the questions that we got a lot coming into today's trading session is why haven't Treasury yields fallen more than they have? So if you look at what took place in the 10-year Treasury yield back in September of 2024, we hit around 360, and that's when equity markets were still around all-time highs. That was before the Fed even cut rates. So there was an expectation that, yes, yields have declined, but maybe not as much as what you would expect in this type of equity market drawdown. And a couple things to point out as to why Treasury yields have not fallen, ignoring today's price action for now. But the 10-year Treasury yield is very correlated to the Fed funds rate. In particular, we'll call it the trough rate. So what markets expect the Fed funds rate to get to over time. If you look back at the market expectations for Fed cuts back on September of 2024, remember, this is before the Fed even cut rates, but markets had priced in 10 rate cuts throughout 2025. So the markets were really aggressive in pricing in rate cuts. So that's how we got down to those, or under that 3.6% number. As of Friday's close, we were pricing in around 3 or 4 cuts. And I think we could have gotten further, but Jay Powell was in the news on Friday talking about patience again. So we were actually down into the 390s on Friday until he came out and started, taking a wait and see approach to see how these tariffs would actually work out in practice, not just in theory. So we saw a little bit of a sell-off there. So it really does matter how aggressive the Fed is going to be, or expected to be, as it relates to that 10-year Treasury yield. Markets have priced in again around 4 cuts this year, so we'll see if that sticks or not. But if we don't see the hard data worsen relative to kind of what we've seen out of the soft data, I mean, we might not get those 4 cuts, so we could see upward pressure on Treasury yield. So a lot of uncertainty on the back end of the curve there. The other thing I would point out too is that the curve isn't that steep. So if you look at the difference between the 2-year Treasury yield and the 10-year Treasury yield, you're only gaining about 40 basis points of incremental yield to move from 2-year yields out to 10-year yields. It's one of the reasons why we've been adamant about not extending duration in our portfolios. It's just you're not getting compensated to take on that additional rate risk, given kind of all the issues with issuance and deficits and now stagflation concerns. Our view was that we probably weren't going to see the 10-year Treasury yield fall much, around 375 to 425 has been our target all year. I still think that makes sense, absent any sort of deep recession. So I think we're kind of stuck in these levels for the time being. Last comment on kind of maybe why we didn't see Treasury yields fall more than what we would expect is that trade surpluses are generally good for bonds. So if you think about the trade surplus that we have with these other countries, we buy their stuff, we give them dollars to pay for that stuff, they give us their stuff, and they turn around and use those excess dollars and invest in Treasury securities, amongst other U.S. assets. Of the, call it $26-27 trillion of marketable Treasury debt outstanding, foreign investors owned about $8.5 trillion of that. And then of that $8.5 trillion, about half of that is due to trade surpluses. So if the goal it really is to reduce those surpluses, that effectively means there's going to be fewer foreign dollars investing into our markets at a time when issuance is expected to increase. So there's a lot of things out there that that aren't great for the long end of Treasury yield curves right now. Again, one of the reasons why we've been adamant about not extending duration, why we talk about 1 to 5 year parts of Treasury curves and corporate curves are that sweet spot because they don't have that or as much risk in those parts of the curve as you see in the long end of the curves. And then finally, and we wrote about this in the weekly market commentary, there are those stagflation risks. So if you want to move ahead one slide. There we go. So what we're seeing in the fixed income markets is not a good combination as it relates to duration. So what we're showing here is 2-year real yields, which are just tips yields. These are Treasury securities adjusted for inflation. And then we're looking at these 2-year inflation expectations. They're going in different directions, meaning inflation expectations are moving higher. At the same time, growth expectations are moving lower. That's the kind of the classical definition of stagflation. Doesn't tend to work great for longer maturity Treasury securities or longer maturity fixed income securities in general. So I think there's going to be volatility as that tug of war between growth and inflation plays out over the rest of this year. The tariffs we've heard are inflationary. That's what the concern is. But there's also a negative growth story associated with that. So until that tug of war goes away, we're likely going to see a lot of volatility in the back end of Treasury yield curves.
This market is nothing like the 1970s, but we learned in the 1970s that stagflation is not friendly to stocks. So this is clearly a challenge that the markets are going to have to work through. Who do you think wins the battle, Lawrence?
Yeah, it's definitely not like the 70s and 80s. That's why it's the light for sure. We don't think inflation is going to get back into those very onerous levels that we saw back in the 70s. But if it does bring back the 80s music, I'm for it. But as it relates to kind of 100%. Who wins the tug of war, unfortunately, I think it's probably going to be the growth side. We've seen a lot of economists lately, including our very own Dr. Roach, reduce our growth expectations and increase our recession call marginally. Our view is that there's only about a 30% chance of recession this year. But certainly that's a fluid number and can change based upon kind of how these trade wars, how these, these tariff dynamics play out. If the growth story or the growth concerns continue to dominate the inflation concerns, though, we could see yields a little bit lower. But I would stick within that, very front end of Treasury yield curves up to that 5-year tenor if you're buying Treasury securities outright. but it could be pretty volatile until that tug of war, figures itself out.
And do we have to worry about China selling our treasuries to try to get a better negotiating position?
That's a great point. So they are still a very large owner of Treasury securities. And if you look at the playbook for Trump 1.0, China did sell a lot of Treasury securities into the market. It wasn't as impactful to Treasury markets during that time period because a lot of other foreign buyers stepped up and bought Treasuries, given the concern about global growth. But with tariffs levied across the globe, there's concern about their economies and potentially going into recession as well, which means a bigger demand for their own bonds versus our bonds here in the U.S. So it's a risk for sure that we could see that selling by those foreign buyers.
And how about the credit markets?
Yep.
Have you seen anything that tells you that maybe recession is coming and that our odds are too low?
To your point earlier, this is still relevant to the slide about all relative calm in the bond market. And I say relative because it's not been calm, but relative to kind of the equity market, we haven't seen the same sort of volatility. There's two charts here on the left-hand side. We're looking at the corporate credit spreads of the high yield indexes and as well as the high grade index, and we have seen spreads widen. So the high yield spreads have widened by about 1.7% over the past month and a half. High grade spreads are higher by about 32 basis points. And that sounds worrisome, and it is. I mean, you never like to see spread widening to that extent this quickly. But if you look back over a longer horizon, what we're seeing is, I think, just maybe a sell-off that kind of gets us back into more normal ranges, if you will. So despite the 1.7% higher in high yield spreads, we're still only around longer term averages in terms of percentiles. So I think we're around 425-ish, 427-ish for high yield spreads. That's right around the historical average over time since 2001. High grade spreads, they're at 1.09% over Treasury securities. They're actually in the 33rd percentile relative to history. So it has been an aggressive sell-off, but I think it kind of gets us back to more normal levels. If you consider what spreads traded like during Trump 1.0, high grade spreads were in the kind of the 110 to 140 range, whereas high yield spreads were in the, call it 350 to 450 range. So this sell-off has kind of gotten us back to what we would expect or what we experienced under the first Trump administration. I would argue that we're not ready to buy the dip in the corporate credit markets just yet, given the volatility, given the uncertainty. High yield looks a little bit better because of the sell-off recently, but I think you really have to have a higher premium on spreads to get interested, given all the volatility that we're seeing in markets right now.
It's interesting that we're at pretty average typical spread levels, and we're back to average typical PE ratios on the S&P 500.
Well, and I think that
argue that the 10-year yield is a pretty average typical level if you look at long-term history.
That's absolutely right. And that's one of the things that we talk about. As when we came into this year, there was a lot of concern about valuations. It was part of our pragmatic optimism story. That we thought there was a lot of reasons to be optimistic, but valuations were not one of those reasons. For credit spreads, we've been at or near secular tights over the last couple months. One of the reasons why we've been avoiding credit for the most part. So this sell-off has kind of gotten us back to those more normal, more average levels.
Yeah. So Adam or Christian, who wants to weigh in on the bond market? Technical observations.
Easy questions only.
Lawrence, you're gonna have to call my wife because I talked to her this morning and we've been waiting to refi our house. And I said, oh, we're probably at those levels earlier today. And now I have to call her back and tell her just kidding because yields have shot higher. So I might have you break the news to her. You can explain it better. Technically, when we look at the 10-year chart, for example, hard to ignore what we call a big head and shoulders top pattern. That we did break the neckline there at 410, but now we've whipsawed, of course, intraday above it. I do think it does suggest we're trending lower really since the start of the year, and yields, same thing on the 2-year, but more probably in this kind of range bound market. It's hard to make the case we're going to take out those 360 lows from September if we're not talking about a severe recession here. So I think the call for Lawrence, 375, 4.25, I think technically that makes sense still as well.
Yeah, I think a lot of it does hinge on the economic data over the next couple of quarters. If we start to see a slowing economy, we could see yields fall from where they are. But given what's priced in terms of rate cuts, with 4 cuts priced in right now, and remember the dot plot that we got from the Federal Reserve, what was it, last month, showed only 2 cuts this year. So markets have already priced in more cuts than what they've told us recently. So I wish that the 10-year Treasury yield was lower. That would help mortgage rates, become more attractive. But I think it's going to get, it's going to take a lot to get a lot lower than where we are, and that reason is going to be recession, unfortunately.
Yeah, I would just chime in on spreads. I think some people in the market were a little surprised by how not dovish Powell was on Friday, and I think it goes completely to what Lawrence is saying, that we've seen a bit of a spike, but it's just basically taking us back to normalized levels. You probably have to see much more aggressive widening in spreads for the Fed to feel compelled, because that's probably where the so-called Fed put comes in, is when credit starts to get out of hand, and it's just it's not there yet.
Yeah, I don't think anybody's counting on a Fed emergency cut intra-meeting to save us. It's really, even a cut in May, which seems to be what most expect, is probably not going to help offset this too much. What could offset some of this, in addition to, a negotiation where the Trump administration backs off some of these high tariff rates, is tax cut extensions that could come as soon as June or July, that are getting bigger because they have the revenue from the tariffs to potentially offset it. And they're making progress on this already. Certainly the prospects of recession can light a fire under Congress, in this case in particular the Republicans, to get more done than they might otherwise. So there's enough potential firepower in the tax cut extensions to really help this market stabilize, or maybe make a move higher. Hopefully we're stabilized before June, but certainly that's the whole sort of spinach and then candy argument that we've been making here over the last couple of weeks. The better stuff comes later. This is maybe where unfortunately the markets have to take their medicine. So turning to the week ahead, I don't think that any of this data matters, but maybe I'll just go around the horn. Why don't we start with you, Adam? What are you watching this week? Either something that's on this page or something that's not.
I think, well, we'll start. I'll take the easy one. Earnings kicking off Friday with the big banks.
Oh, that was going to be mine, and
that'll be an interesting one, but I'll let you cover that in detail. Something I'll be listening to, and just the reaction there. Again, to your point,
pick another one.
CPI and PPI are going to matter, or the inflation metrics that we're going to get. I think just how the market handles some of these support levels, call it that 4820 level on the S&P 500. Do we start to have some intraday reversals? That seems to be the case, at least today. I think that's a good sign. And just where volumes are, who's buying as well. Do we get any type of institutional demand coming back into the market? They really haven't been around for the first quarter. They've been selling stocks. Be interesting to see if, with them being relatively light in this sell-off, did they take advantage of it and start buying equities? Haven't seen that yet, but something I'll be watching for this, really to assess the sustainability of a rally here.
Over to you, Christian. What are you watching?
Yeah, something that's not on here, I'd say there's a lot of central bankers on the tape expected, both in the U.S. and abroad. So they could have a role here in terms of maybe changing the tide if they are kind of more uniformly dovish. But like you've been saying, Bookie, it really comes down to we need some positive news regarding trade. I believe Trump has a press conference with some members of the Israeli government later today. So say a trade deal gets announced there with them, that could be maybe something that starts sparking the, changes the tide a little bit. So that's really what I'm on the lookout for, is just anything positive on the trade side to kind of change just the negative narrative that we've had the last few days.
Lawrence, hopefully Christian didn't take yours.
He did not. That is a good one, though. If we're playing Family Feud, I would have been like, good answer. But no, I think for the bond markets, the Treasury Department has some auctions this week. So we'll see if foreign buyers show up. They have a 3-year, a 10-year, and a 30-year auction. Not big numbers because the 10-year and the 30-year are reopenings, but it should be a good test to see if there is demand out there for Treasury securities. With the backup that we've seen today, I would think that that would increase the chances of buyers coming back into the market, but we'll have to see that mix between international buyers and foreign buyers, or I'm sorry, international buyers and domestic buyers.
All right. Well, mine already. It's earnings. I don't think we're going to get a lot of information in terms of guidance that can help us, because companies, management teams are dealing with the same thing we're dealing with, right? We're just waiting to see where these tariffs land after negotiations. But what will be interesting, I think, is how much pressure corporate America is putting on the Trump administration to either negotiate quickly and bring these rates down, or to somehow change their approach to something that's a little less of a recession risk or bear market risk, right? You've seen a lot of headlines over the weekend. Trump administration's getting a lot of heat, frankly, from a lot of different places. And if they go too far, we're going to see job losses. And then they're going to get pressure, not just from stock investors or CEOs, but from working people. And that's not where they want to be. So it's hard to know where there is a Trump put or a Fed put or any put, frankly, that could put a floor under this, where the weakness and the heat gets to be too extreme and they back off. But there is a point where that happens. Oh, by the way, there's a little bit of a Congress put here too, where Congress could potentially do something to push back. I'm not counting on it. I don't think we're going to invest around that necessarily. But my only point there is there are a lot of things that can be, let's call it, less negative here and help the markets turn around. So those are some of the things I'll be watching for. Thank you guys. Really appreciate it. Adam, Christian, Lawrence, good around the horn. This is a tough time. There's a lot of complex issues. It's really hard to predict. But so we're just looking, just like all of you, looking for better headlines. If we get them soon, we think we could get back to the recent highs here before the end of the year. Might be a bumpy ride to get there, but we think there's a decent chance that that's how this plays out. So thank you for listening to Market Signals. Appreciate your support, and we'll be back with you next week. We'll see if we go with the quad box, or maybe back to the 2-speaker model next week. We'll just see how volatile the markets are. So thanks again for listening. We'll see you next time.